Today is Monday, June 1st, 2026, and you are listening to a brand new deep dive into the underlying structures of global finance.
Absolutely.
Yeah, and just as a quick note, our data collection and research for today's topic was conducted in May 2026, just to give you the most up-to-date analysis possible. So welcome to Macroeconomy AI.
Glad to be here for this one.
For sure. And the episode title today is, What are US REITs? So let's just get right into it. I want you to imagine, just for a second, owning a slice of a massive, hyper-cooled data center.
Oh, wow.
Right, like the kind that is currently powering the global AI revolution. Or, maybe you own a piece of a towering skyscraper in Manhattan, or even a sprawling logistics hub processing millions of e-commerce packages every single day.
Which is a huge deal right now.
It really is. Now, imagine holding all of those assets without needing $1 billion in capital, and perhaps more importantly, without ever getting a phone call at 2 in the morning because the roof is leaking.
I mean, it sounds suspiciously like a late-night infomercial pitch, to be honest.
Right. Buy my course.
Exactly. But what you are describing is actually a highly regulated, mathematically complex cornerstone of the modern financial system. We have a really fascinating structural breakdown ahead of us today.
We really do. But before we unpack the mechanics of how this all works, I just want to say a massive thank you to you for tuning in. Channel. Macroeconomy AI is bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence.
And, doing that deep analytical work requires good tools.
Oh, absolutely. And that mission is made possible by today's sponsor, DataStream Pro. If you are constantly drowning in market noise and need crystal clear, real-time macro data visualized at the push of a button, DataStream Pro is your ultimate analytical dashboard. Click the link in our description to get your first month free.
It's honestly a genuinely powerful tool for anyone trying to, isolate the actual signal from the market noise.
Yeah.
And analyzing signals is exactly what we need to do when we talk about REITs or real estate investment trusts.
Yeah, it's an acronym thrown around constantly in financial circles, but it's rarely actually dissected. So let's establish the baseline here. Legally speaking, what separates a REIT from any other company that just, happens to own a lot of property?
Well, fundamentally, a REIT is a specific legal entity. It can be structured as a corporation, a trust, or an association, but the defining characteristic is that it actively elects to be taxed under Section 856 of the U.S. Internal Revenue Code.
Section 856, okay.
Right. It is a special tax designation with incredibly strict guardrails. So to maintain this status under IRS rules, a minimum of 75% of the entity's total assets must be invested directly in real estate, cash, or U.S. government bonds.
Wow, 75%. That is a massive chunk.
It is. And on top of that, 75% of its gross income has to be generated strictly from real estate sources. We are talking about, collecting rents, earning interest on mortgages, or the capital gains from the sale of properties.
Okay, so a multinational tech company can't just throw its sprawling corporate headquarters into a REIT structure just to dodge taxes.
Yep. No, absolutely not. The entity has to be purely focused on the business of real estate.
Got it. But the history of how this structure came to be is what I find really fascinating. You'd think this level of financial engineering was some, modern Wall Street invention, but the origin story actually takes us all the way back to September 14, 1960.
Yeah, the legislative history is surprisingly obscure. The creation of the REIT structure was actually tucked away inside a piece of legislation called the Cigar Excise Tax Extension Act.
The Cigar Excise Tax.
Yeah, signed by President Dwight D. Eisenhower.
That is just so funny to me. Like, let's extend the tax on cigars, and while the pen is out, let's completely revolutionize the structure of global real estate finance. It is wild.
It's a very bizarre pairing, for sure. But the underlying intent of that 1960 law was incredibly strategic.
How so?
Well, it was profoundly strategic if you look at the macroeconomic landscape of the mid-20th century.
Yeah.
Commercial real estate, so office buildings, massive apartment complexes, regional shopping centers.
All the big stuff.
Exactly. All of that was entirely locked off to the average retail investor. The capital requirements were just way too high.
Right, because an average person can't just buy a skyscraper.
Precisely. It was the exclusive private playground of ultra-wealthy individuals, syndicates, and, massive institutional funds. So the explicit declared purpose of this legislation, as recorded in the congressional record, was democratization.
Wow, so it was essentially crowdfunding commercial real estate decades before the internet even existed.
That is exactly what it was. It allowed an everyday investor to buy shares of a diversified, income-producing real estate portfolio on a public stock exchange.
And with the exact same ease as buying shares in, like, a steel manufacturer or a railroad company.
Right. But that democratization required an incentive, right? Congress gave these entities a massive tax advantage, specifically avoiding double taxation, which we will analyze in a moment. But because of that massive tax shield, Congress was naturally terrified that the ultra-rich would just use REITs as personal tax shelters. To prevent that, they engineered 4 primary defensive mechanisms into the qualification tests.
Okay, let's break down those defenses because, I mean, if I'm a billionaire in 1960, what stops me from just throwing my private mega mansion into a REIT structure to avoid paying taxes on it?
Well, that exact scenario is why the shareholder test exists. After its first year of existence, a REIT must have at least 100 distinct shareholders.
Okay.
It cannot be a closely held secret club for you and 2 business partners. It actively forces broad public participation.
Right, but play devil's advocate here. A billionaire could easily just hire 99 random people, give them 1 share each, and keep 99% of the company for themselves.
Which triggers the second defensive mechanism.
Oh, they thought of that.
They did. It's the 550 rule. This is a strict mathematical barrier. During the second half of any tax year, no more than 50% of the value of the REIT's outstanding shares can be held by 5 or fewer individuals.
Oh, wow.
Yeah, if 5 people own 51% of the value, the entity instantly loses its REIT status. It becomes what the IRS penalizes as a personal holding company. So the math explicitly enforces broad, decentralized ownership value.
That is a very clever mechanism.
Yeah.
It forces the wealth to actually spread out. So the third defense is the 75% asset and income test we just discussed, right?
Yeah.
Keeping the business strictly in real estate.
Correct.
But the fourth rule, this is the one that seems totally counterintuitive for running a business. The mandatory distribution rule.
Right. Legally, a REIT must distribute at least 90% of its taxable income to its shareholders every single year in the form of dividends.
Okay, I have to push back on the viability of this. If a normal corporation is forced to bleed 90% of its taxable income out to shareholders every 12 months, how does it survive?
It is definitely a challenge.
Like, how do they acquire new properties or fund a massive renovation or simply, build a cash buffer for an economic recession? Standard corporations survive and grow by retaining their earnings.
You've hit on the ultimate structural friction of the REIT model. And the answer is the pass-through tax structure.
Pass-through. Okay, explain that.
So in a normal corporation, the company pays corporate income tax on its profits, and then the shareholder pays tax again when they receive a dividend. That's double taxation.
Right, the classic corporate tax drag.
Exactly. But by legally forcing the distribution of 90% of income, the REIT avoids paying corporate-level income tax entirely. The tax burden and the massive pile of cash passes straight through the corporate layer and lands directly on you, the investor.
Okay, so the tax efficiency is incredible.
Yeah.
But my question about growth still remains. If they have no retained earnings, their bank accounts must be running close to empty.
Well, they are. Because they cannot stockpile cash, REITs are structurally tethered to the capital markets.
No, I see.
Yeah. If a REIT wants to buy a new shopping mall or build a new logistics hub, they have to constantly issue new stock or take on new debt. If their stock price is high and the market loves them, they issue equity to fund acquisitions. If credit markets are favorable, they issue corporate bonds.
But that means if the broader stock market freezes up or credit markets tighten, a REIT's ability to grow essentially hits a brick wall. Like, they are hyper-dependent on external capital.
They absolutely are. It forces intense capital discipline. A REIT manager can't just hide poor performance behind a massive pile of retained cash. They have to constantly prove their value to the open market to raise the funds they need.
So let's look at what that open market actually consists of today. Because when we say real estate, I think the default image is an apartment building or like a suburban shopping mall.
Sure, that's the classic image.
But the FTSE NIREIT classification system actually tracks 14 entirely different sectors.
Yeah, the physical infrastructure of the modern economy is just staggering. Beyond malls, you have timberland REITs managing millions of acres of forests. You have infrastructure REITs owning the cell towers that route our mobile data.
Wow, cell towers too.
Yep, you have self-storage facilities, and currently the most aggressive sector, data centers.
Right, the physical fortresses of the AI boom. During our data collection for this deep dive, we looked at Equinix, which is a behemoth in the data center space.
They really are.
Now, just for the sake of rigorous transparency here, our primary source audit flags something. The most recent exact 2024 financial metrics for Equinix could only be sourced from secondary market estimates during our research window.
Right, that's an important distinction.
Yeah, those secondary estimates place their market cap around $105.6 billion in early 2026. But since we couldn't verify the final 2024 FFO through their primary SEC filings in time, we do want to flag that number as an estimate.
Strict primary verification is absolutely essential. But to analyze the mechanics of a massive, fully verified entity, we can actually look at the industrial and logistics sector.
Okay, who's the standout there?
Prologis provides a flawless case study. Based on their audited SEC filings at the close of 2024, they controlled $95.3 billion in total assets.
$95.3 billion, just massive scale.
It is, and to contextualize that scale, they carry roughly $30.9 billion in debt. And at the end of 2024, their global portfolio of warehouses operated at a 97.1% occupancy rate.
That is almost completely full.
Think about the physical mechanism of the global e-commerce supply chain. Every time you finalize an online purchase, the physical movement of that product is overwhelmingly likely to pass through an industrial REIT facility like a Prologis logistics hub.
So they basically own the physical plumbing of the digital economy. Now, if I am analyzing Prologis, or really any of these entities, and I pull up standard financial metrics like a price-to-earnings ratio, the numbers usually look terrible. The PE ratio for a highly successful REIT will often look totally broken. Why does standard accounting fail so spectacularly here?
Well, it fails because of the friction between reality and standard accounting principles.
How so?
Under GAAP, which is generally accepted accounting principles, a company is legally required to deduct depreciation from its income. The accounting rules assume that a physical building naturally degrades and loses value over time, in the exact same way a factory machine or a fleet of delivery trucks loses value.
Oh, I get it. It's like owning a taxi. Standard accounting forces you to deduct the fact that the car is getting older, wearing down, and losing resale value every single day. So on paper, the taxi business looks less profitable.
Exactly. But unlike a used taxi, commercial real estate values generally appreciate over time.
Right. Buildings usually go up in value.
Right. So by forcing REITs to deduct millions of dollars in artificial depreciation every quarter, GAAP accounting makes incredibly profitable real estate portfolios look as if they are actively losing money.
So how do we actually measure the cash they are making? Because GAAP clearly isn't working here.
The industry body, NAREIT, engineered a non-GAAP metric specifically to solve this exact distortion. It is called FFO, or Funds from Operations.
Funds from operations.
Mechanically, it takes the standard net income and then adds all that artificial depreciation back into the equation. It also subtracts any one-time cash injections from selling off a property.
Because selling a building isn't a recurring operation, right?
Exactly. FFO essentially strips away the accounting fiction.
So to stick with the taxi analogy, FFO ignores the theoretical depreciating value of the car and just counts how much cold, hard cash is actually sitting in the glove box at the end of the shift. That gives you the true operating picture.
That's a great way to look at it. But then we introduce FFO-adjusted funds from operations, and this is where the math gets highly subjective. Subjective math in finance is usually a red flag.
It is the definition of diagnostic muddy waters. FFO is a strictly recognized, mathematically standardized industry metric.
Yeah.
AFO has no legally standardized formula whatsoever.
Wait, really? None?
None. The theoretical goal of AFO is to be even more precise by taking that cash in the glove box and subtracting recurring capital expenditures.
CAP. Yeah. So the actual unavoidable cash it costs to keep the building physically operational, like replacing the HVAC system or repaving a crumbling parking lot?
Yes, but the friction lies in the word recurring. Because the formula isn't standardized, different management teams define capital expenditures differently.
Oh, I see where this is going.
Right. One REIT manager might classify a multi-million-dollar lobby renovation as a necessary recurring expense to keep tenants, which lowers their AFFO. Another manager might classify the exact same lobby renovation as a one-time growth investment, which keeps their AFO looking artificially high. Which means you cannot just blindly compare the AFO of two different companies on a simple screener tool. You actually have to open the financial statements, dig into the footnotes, and reverse engineer what the manager decided to include or exclude.
It requires forensic analysis by the investor, and that level of analysis has been extremely crucial over the last few years because the macroeconomic environment has thrown everything it has at this sector.
Yeah, if we track the historical performance of the FTSE Nareit All Equity REITs Index from 2021 through 2025, the volatility is just extreme.
It's been a wild ride.
It has been financial whiplash. In 2021, driven by the post-COVID environment, all equity REITs exploded with a 41.3% return. But then 2022 hit like an absolute brick wall, resulting in a crushing 24.9% drop.
Ouch.
Yeah, 2023 saw a partial recovery, up 11.4%. But then 2024 and 2025 basically ground to a halt with sluggish, low single-digit growth. If the physical buildings were still collecting rent, what triggered that huge 2022 crash?
To understand REITs, you must accept one fundamental law of physics. Interest rates are the gravity of the real estate universe. The 2022 crash was a direct mechanical response to the U.S. Federal Reserve aggressively hiking interest rates to combat inflation.
Hold on. If interest rates dictate everything, does that mean REIT managers are essentially just at the mercy of the Fed, regardless of how flawlessly they run their buildings?
They are heavily constrained by the Fed, yes. Think about the mechanics from an investor's perspective. If you are buying a REIT, you are primarily buying it for that mandatory dividend yield.
Right.
Let's say a high-quality REIT offers a 4% dividend yield. In an environment where interest rates are at zero, that 4% is highly attractive.
Because you can't get yield anywhere else.
Exactly. But the moment the Federal Reserve raises rates, and suddenly you can get a guaranteed risk-free return of 5% just by buying a U.S. government treasury bond. Why would you take on the risk of the stock market for only 4%?
You wouldn't. Capital immediately flees the REIT sector for the safety of government bonds.
Exactly. Investors mass sell the REIT shares. That selling pressure drives the stock price down. And mathematically, as the stock price drops, its dividend yield goes up.
Oh, right.
The stock price will basically continue to fall until the REIT's yield is high enough to be competitive with government bonds again. Furthermore, high interest rates make the cost of borrowing new debt astronomically expensive, which chokes off the REIT's ability to grow. Interest rate risk is the apex predator of this sector.
But it's not the only risk a manager has to navigate, right? Like, even if rates are stable, you have vacancy risk. If a major corporate tenant suddenly goes bankrupt and vacates a massive office tower, your net operating income plummets.
Vacancy risk is definitely the fundamental operational variable. And then there's credit risk, which operates entirely differently, particularly within a subcategory known as M REITs or mortgage REITs.
Right. Up until now, we've been analyzing equity REITs, which physically own and operate the concrete and steel. M REITs don't own the buildings. They just deal in paper.
They own the debt. They purchase or originate mortgages and mortgage-backed securities. Their revenue is the interest paid on those loans.
Okay, so they are acting more like a bank.
Very much so. Therefore, an REIT doesn't care if the roof leaks or if a tenant moves out. Their exclusive risk profile revolves around credit risk, the mathematical probability that the underlying borrower will default on the loan.
It is an entirely different business model wrapped in the exact same tax structure, which actually brings us to the final major risk vector, regulatory risk. We established that REITs only exist because of a specific line of the U.S. tax code.
Right, Section 856.
But tax codes are not carved in stone. A really fascinating scenario played out recently regarding international capital flows and something called the domestically controlled REIT look-through rule.
Yes, it is a perfect illustration of how stroke-of-a-pen risk in Washington alters global markets. Under U.S. law, specifically a complex regulation known as FIRPTA, the Foreign Investment in Real Property Tax Act foreign investors can be subjected to incredibly heavy taxes when they sell U.S. real estate assets.
Got it.
However, if a REIT was deemed domestically controlled, meaning less than 50% of it was owned by foreign persons, those foreign investors could often sidestep the heavy FIRPTA tax upon selling their shares.
Which was obviously a massive incentive for global capital to flow into U.S. real estate.
Huge incentive. But in April 2024, the U.S. Treasury and the IRS finalized new regulations that completely changed how they measured that 50% threshold.
What do they do?
They implemented a look-through rule. Instead of just looking at the corporate entities holding the shares, the IRS granted themselves the power to look straight through those corporate shell structures to identify the actual ultimate human owners.
Oh, wow. So no more hiding behind shell companies.
Exactly. And there were proposed reversals discussed in late 2025, but the damage was kind of already done. If that look-through revealed that foreign ownership was actually above the threshold, foreign investors were suddenly exposed to massive, unexpected tax liabilities.
That fear of a surprise tax bill from Washington doesn't just spook international investors. It actively drives them to look at their own domestic alternatives. Which actually makes me wonder, if a Brazilian investor gets spooked by U.S. tax laws, what are they buying at home? Because we look at a comparative analysis of the U.S. system versus Brazil's equivalent structure, FIIs, or Fundos de Investimento Imobiliário.
It is a phenomenal point of structural comparison. The US REIT market is a behemoth, commanding over $1.4 trillion in equity market capitalization.
Trillion with a T.
Right. But the Brazilian FI market is expanding rapidly as an alternative. It recently crossed 180 billion reais in market size, driven by over 3 million retail investors. However, structurally, the mechanics of FIIs operate under entirely different incentive models.
Yeah, the friction really starts at the management layer. A heavyweight U.S. REIT, like Prologis, is typically internally managed. The executives and the team managing the buildings are direct employees of the REIT itself. Their salaries are paid by the company.
Right.
But Brazilian FIIs legally mandate an entirely different structure.
They do. Brazilian FIIs are legally classified as closed-end funds. They are fundamentally prohibited from internal management. They are legally obligated to be managed by an external administrator, which is usually a massive financial institution authorized by the CVM Brazil's regulatory equivalent of the SEC.
This external structure creates a very specific conflict of interest, because the external manager's fee is usually calculated as a flat percentage of the total assets under management, the AUM.
And that is the structural tension right there. If the external manager is paid a percentage of the total asset pool, their primary financial incentive isn't necessarily to maximize your monthly dividend yield.
Right.
Their most lucrative incentive is simply to buy more properties to artificially inflate the total asset pool. That automatically increases their management fee, regardless of whether those new properties are highly profitable for the individual shareholder.
Which means it requires the investor to monitor the manager's motives constantly. But the trade-off for that structural friction is the payout rule, which is even more aggressive than the U.S. We know U.S. REITs must distribute 90% of taxable income. Brazilian FIIs are legally bound to distribute 95% of their accumulated cash profit, usually on a monthly basis.
95% cash distribution. And the resulting tax treatment is really the primary engine behind those 3 million Brazilian retail investors.
How so?
In the U.S., when a REIT dividend hits your brokerage account, it is overwhelmingly taxed as ordinary income. NAREIT data historically shows that roughly 78% of a U.S. REIT dividend is taxed at your standard personal income tax rate. It provides no special shield for the end user.
But in Brazil,
for the individual retail investor, those monthly FII dividends are entirely tax-exempt, provided the fund meets broad ownership criteria and is publicly traded.
tax-exempt monthly income. That is an incredible wealth-building tool. But this creates a very complex scenario for international players. Let's walk through the math for a global listener. Say you are a Brazilian investor. You look at the heavy tax burden of the U.S. system, but you want exposure to massive logistics networks like Prologis. So you buy a U.S. REIT. You are immediately stepping into a massive invisible variable, currency risk.
FX risk.
Wow.
It is the silent destroyer of international yields. If you are a non-U.S. investor buying a U.S. REIT, both your underlying asset value and your dividend stream are denominated entirely in U.S. dollars.
All right, so let's run the exact mechanics of that scenario. Imagine the U.S. REIT performs flawlessly. The property values are stable, the tenants are paying rent, and you are receiving a solid 4% dividend yield.
Sounds great so far.
But over the course of that year, the macroeconomy shifts, and the U.S. dollar drops 10% in value against your local currency, the Brazilian real.
The math is unforgiving. Even though the real estate itself performed perfectly and you collected your 4% yield, when you convert those dollars back into reais to spend in your local economy, you have lost 10% of your purchasing power.
Wow.
The currency depreciation entirely wipes out your dividend yield and leaves you with a net loss.
So you are simultaneously taking on the physical risk of the real estate market and the macroeconomic risk of global currency markets.
Which is exactly why analyzing real estate in isolation is a flawed strategy. Understanding the macroeconomic gravity, so inflation dynamics, central bank interest rate differentials, and global currency flows, is every bit as critical as understanding the structural integrity of the building itself.
That perfectly frames the complexity of what we are analyzing here. Let's pull back and look at the macro picture of what we've unpacked today. We have journeyed from a 1960 tax loophole meant to democratize wealth, all the way to the artificial accounting of depreciating assets and the volatile mathematics of global currency exchange.
It's a lot of ground to cover.
It really is. So what does this all mean for you navigating the market today? I want to leave you with this final provocative thought to mull over. We constantly hear that our world is becoming increasingly virtual, right? We spend our professional lives on remote servers, we route our social lives to the cloud, and we increasingly outsource our cognitive labor to artificial intelligence. It feels entirely digital, but our reliance on physical real estate hasn't disappeared. It is simply shape-shifted. The capital that used to build regional shopping malls has morphed into constructing massive, energy-devouring AI data centers and sprawling, automated logistics warehouses spanning millions of square feet. The physical footprint of the digital age is still ultimately built on land. And understanding who owns that land and how they finance it is the key to understanding the future economy.
The digital economy demands immense physical infrastructure. That is a truly powerful synthesis of the data. And before we close this analysis, I must provide our mandatory legal disclaimer. This content is exclusively informational and educational, compiling public market data. It does not express ideological bias and does not constitute investment, financial, legal, or tax advice. Economic projections change, and past performance does not guarantee future results. Strategic decisions require personalized analysis by qualified professionals.
Thank you for laying out those parameters. And thank you for giving us your time and joining us on this deep dive. We hope it clarified the mechanisms and the global stakes of real estate finance. We have plenty more deep dives into the mechanics of the market coming your way, so keep exploring with us. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.